just whilst we're waiting for the few more to join, and before we start with introductions, I'm just going to pop some links into the chat box. Those links are for both L&G's corporate website, the advisor site, as well as their socials, and similarly for AdviceWise, our socials and our corporate website. If you haven't already, please feel free to check those out, favorite them, sign up if you haven't done already, but I've just popped them into the chat box so you can all see it. But we're a couple of minutes past now. We'll get cracking straight away. So yeah, to formally start, good morning, everyone. Thanks for joining us. Thank you for taking the time this Tuesday morning. We'll go through some normal housekeeping in just a brief second, but just to introduce the title of today's session, it's Adapting to the Market, Unlocking Opportunity, the Role of the Later Life Advisor and Later Life in Modern Financial Advice. As the financial landscape continues to evolve, advisors are increasingly recognizing the importance of later life lending as a vital part of comprehensive financial planning. In today's session, we're joined by Nick. Nick will examine why every advisor should be considering a later life market and how it can enhance client outcomes and, in turn, business growth. Now, onto housekeeping. Hopefully, we're not new to some of these webinars and sessions, but if you can keep your microphones muted for the most part, feel free to keep your cameras on. It is nice sometimes for us as speakers. I'm sure Nick will nod here. It's nice to see those friendly faces and friendly names that we meet out and about on the road. The session is being recorded. You'll have noticed that symbol at the top of your screens. You'll get a replay afterwards. You'll also get a link to generate some CPD certificates. So make sure that you stay right until the very end and get those downloaded as soon as you can. The rough structure for today's session is a bit of an introduction by myself. Nick's going to present some slides from L&G and talk around the subject that we've just discussed. And then we'll get an opportunity to ask some questions towards the end of the session. We have allocated for that. So be sure to familiarize yourself with the chat box at the bottom of your screen and pop any in there that you want to ask Nick directly. If you want to ask something live and unmute yourself, we welcome that as well. Advisor engagement's incredibly important for these sessions. Just flag it in the chat box and I'll line you in where I can. For those that don't know myself, I'm Daniel Edmondson from AdviceWise. AdviceWise are a later life sourcing platform and mortgage club, and our focus is predominantly on providing advisors with the tools, the support, and the insights to deliver best outcomes for clients. Today's session is a really exciting one. We've got Nick Birdseye from L&G. Nick has been a consistent spokesperson within the later life advice sector and is here to examine why every advisor should be considering the later life lending market and how it can in turn again enhance client outcomes and business growth. Nick's worked in financial services for quite some time. In fact, for the entirety of my life, Nick, forgive me, I was having a look at your LinkedIn earlier this week, and I noticed that you joined Aviva probably a month or so before I was born. Now, that's an encouragement for you all to go and have a look at Nick's LinkedIn, of course, and drop him a follow. But that just goes to show the extensive experience that we have on today's session. Nick has seen the market shift through regulation, innovation, and absolutely everything in between. So we are incredibly lucky to have him with us to explore and communicate the opportunities ahead. Legal & General, as a lender, are uniquely positioned in the market as well, with product variants that cover a range of customer needs. Hopefully, we can gather some insights, some valuable insights and confidence in today's session to ultimately, and again, help you deliver those great customer outcomes. Nick, welcome. It's brilliant to have you with us. To hand over now to the main session or the main part of today's webinar, please do go ahead and introduce yourself further and share what's behind the theme of today's webinar title. And of course, in your own time, when you're ready, pop those slides up on screen so we can go through the content with you.
Perfect. Thanks very much for that entirely rude introduction. I can't believe that that's really aged me. But yeah, it's undeniable. I've just sort of ticked over 30 years plus in financial services. I joined GA Life as a trainee financial consultant in 1994. So I've been through the full gamut. I've been a fully qualified financial advisor. I'm diploma qualified. Done mortgage advice, wealth advice, retirement decumulation advice. Run sales teams at both a regional and a national level. in both the retirement space and the wealth planning space, and then joined L&G Home Finance in 2015. But I mean, prior to that, I was involved with Aviva, or what was the Norwich Union lifetime mortgage business from 2000. So I've been in lifetime mortgages for 25 years now, and so yeah, I've seen an awful lot of development in the marketplace, and it's a fantastic place to be. The one thing I'm a real adherent and proponent of our market. It does a fantastic job for customers. We need to be super safe in how we go about our business, so we know that, and some of the sort of challenges associated with our market. At L&G, we're all about raising quality, supporting advisors to be the best that they can be, and helping them understand how they can build their businesses around property wealth. And I think that's where I'll get into the presentation. I'm going to talk today about the importance of property wealth in the current financial climate and the financial climate going forward. Talk about how advisors can engage with that marketplace, either under their own steam or through trusted referral relationships. But most important, I think, is understanding the commercial opportunity that's out there, and how advisors can engage with the marketplace. So I'm usually a Teams player, but I'm on Zoom today, so I'm going to do my best to share things effectively. I've got a slide deck. In this slide deck is an embedded video, which we've tested it a few minutes ago. It looked like it was working fine. When I do play the slides, then I get no view of the Teams meeting. So if anything is going wrong, Daniel, you better ring me on my mobile. That's probably, we'll have to revert to sort of old school. But now I'm sure we'll get through it okay. Question, we've got loads of times for Q&A at the end of the presentation. We've had one or two questions submitted already. I've seen some of the names on the lists of attendees, so welcome everybody. And I'm sure there'll be one or two questions coming through from the attendees, but please put them into the chat and we'll make sure we get them covered off. If I can answer the question, I will do. If I can't, then I'll tell you that I can't. And if I don't know the answer, then one of our BDM team, who really know what they're talking about, will be only too pleased to engage with you. So that'll be my sort of promise for today. So let me share a screen, and then we'll get into what I'm here to talk about. Okay, so I can see, so I'm thinking that you're seeing a slide deck that says title slide, unlocking opportunity. I'm hoping that's the case.
All good, good to go.
Well done, excellent, thank you. Right, okay, so the role of later life lending in modern financial advice, that's what I'm looking at today. So I'll be talking about how lifetime mortgages support modern retirement planning. We'll be looking at how to respond to changing retirement trends and tax rules. We're talking about enabling estate planning and family gifting strategies, highlighting the commercial potential and client impact of our marketplace, and looking at collaboration and referral networks, and then a panel discussion, which is actually going to be a Q&A. So it'll be, the panel will be myself and Daniel. So that's some of the things that I want to cover off today. So why would, if you weren't in our market already, or if you were, but you were only dipping your toe in the market, then why would you really engage with our marketplace? What are some of the upsides of engaging in the later life lending market? And by later life market, I'm talking about really 55 plus lending, and all of the product lines that sit in that space, whether that be standard interest only mortgage, capital and repayment, RIOs, TOs, hybrid lifetime mortgages, interest served lifetime mortgages, full fat lifetime mortgages, and even home reversion plans. That once a customer gets to age 55, then the landscape that they can access with later life lending products really expands. It's a very broad waterfront. And the challenge for advisors is to find the best way, the best solution for their customer in terms of searching across that whole marketplace and finding the best solution for the customer. But why should you engage with particularly the lifetime mortgage market? Well, there's a couple of things. One, we should be looking to increase the embedded value of the client base. And I'll come on to that and sort of pull out a couple of examples of what that looks like, just to provoke that thinking. It broadens your proposition. So as a practice, as an advisory practice, you've got a broader proposition. You can offer more solutions. You can retain customers for longer. You can retain and maximize customer value, both if you're an IFA or a mortgage advisor. And I'll explain some of the thinking behind that. You can generate recurring income, and that's really important. You can lead your peer group. Who doesn't like to go to a room like this? If we were face to face, then who wouldn't want to be in the room and have the best proposition in the room? And you can increase your recruitment appeal. So if you're looking to grow your business and you want to bring advisors into your business, the broader the proposition, the more high quality your advisory practice is, then the better recruits you're going to bring into your business. So we'll move on to the changing face of retirement and some of the major sort of things that have come to pass over the last 40 years, because this puts into context some of the things that I'm going to talk around about property wealth. So if you go back to 1980, when I was still at school, then retirement, or the sort of later life landscape, looked a bit like a very traditional view of the world. So homeowner, married, had a single job career, had a state pension, and probably had a defined benefit pension scheme from one employer. And people would knock off at 65, sit down and wait for God. And retirement generally lasted 5 to 10 years, certainly not the 10 to 20 to 30 years that we're currently looking at and we're currently thinking about funding in terms of retirement. Move on to 2025, then the landscape is very different. More often than not, people get to retirement and they've still got elderly parents in the within their family setup, and that will bring it with the responsibility to care and certainly to manage elderly parents. Could well still have children at home. The average age of a first-time buyer is 35 now, 38 in the southeast. So the chances are you could well get to retirement and still have kids living at home, which is a horrific thought. And the prevalence of blended families, so divorce, exes, children from different familial backgrounds within the environment. Work is likely to have been a multi-job career, which would bring with it multiple pension pots, and they would be defined contribution pension pots. They wouldn't really be nowadays going forward defined benefit pension pots. And on the wealth side, the likelihood is some savings are going to be carried into retirement, as I've talked about, multiple DC pots, but also the prevalence of carrying debt into retirement is going up and up. More and more people are retiring with debt, which needs advice around it, and in many cases refinancing. And on the health front, some really mixed news. The really good news is that nutrition and diet is much better than it was. What that does mean is that people are living longer. Healthcare has improved, which means that things that used to kill you don't kill you anymore. And healthcare is such that people can now live and manage chronic conditions for many, many years. So what that means is people are living longer. Our challenge as an advice and financial services industry is to make sure that they live better. And at the moment, if you're managing chronic conditions with limited means, then you might well live longer, but you may well not live better. So the financial planning landscape, there are several factors which increase the relevance of housing wealth as a retirement planning asset. Reduced pension provision means that all assets should be considered when planning decumulation in retirement. We saw in the spring the CEO of the FCA, Nick Birdseye, commenting that property wealth is going to form an increasingly important asset for people to fund their retirement with. And he also repeated that in the L&G Mortgage Club conference a couple of weeks ago. And then the deputy CEO of the FCA, a lady called Sarah Pritchard, followed up on that theme at the recent TISA conference. So even the regulator is now saying your funding for retirement is not just going to be the unit linked assets or the pension assets that you take into retirement. It's going to be all of your assets, and that includes your property wealth. So we've really got to switch into helping customers, or helping ourselves as an industry, think about homes as assets, not just places to live, and certainly helping consumers think like that as well. We talked already about increasing debt being carried into retirement, and the changing taxation of pension funds, or tax treatment of pension funds. Pension freedom has brought along a happy accident that meant that pension funds were IHT nil rated for up until I think 75, and then so that meant that funds in pension wrappers were extremely tax efficient from an IHT planning perspective. That's changing, so everybody's IHT problem from I think April 2027 will increase by the value of their pension fund, and that brings with it complexity for consumers and opportunity for advisors. And we should be thinking about how we support consumers navigating their way through that. So Noddy's guide to IHT thinking. This is quite basic stuff, but important to be thinking about, and important to be talking to your customers about. That there are assets that are included in their estate for IHT purposes, and this pension change is going to have a significant impact. So main residence, cash savings and investments, so ISAs, whilst they grow tax-free or tax efficient, come into the estate for IHT purposes. Life assurance policies, if not written under trust. Agricultural assets over $1 million. And bear in mind, I live in a country and a combine costs £1 million, so that's not much of an allowance. Business interests and privately held shares, once again a limit of £1 million of those, and then personal possessions, valuable items. So all of that basket of stuff goes into the calculation for estate planning on death. Things that are excluded or treated differently: pension funds currently up until April 27, trust assets depending on the structure and control of the trust, and gifts made more than 7 years before death. Now, we're all wildly anticipating the budget tomorrow, so we could rip this slide up tomorrow and it might all be different, but as of today, that's a reasonable sort of representation of the position. So I said earlier that I talk about the embedded value within customer holdings, and how lifetime mortgages, retirement lending can help free up that customer value. And this is an illustration of I wouldn't say it's a typical IFA practice, but it's an example IFA practice. So if you're an IFA and you're looking after 200 clients, and the average holdings that you've got on platform for those clients are £500,000, then you would measure the value of your practice at £100 million. It's your funds under management. You ask any IFA, what's the size of their practice, and they'll tell you the funds under management. Now, it's not beyond the wit of man to think that if a customer has got £500,000 worth of investable assets, they live in a nice property. And according to Copilot, then the average property value of the mass affluent marketing group or customer cohort is £750,000. So they live in a £750,000 house. So that IFA is also looking after, on behalf of their clients, or has the potential to look after, £150 million worth of property value. Now, I can you put 100 IFAs in a room and ask them how much property value are you looking after, and nobody would be able to answer that question, because at the moment we're not gathering, as part of the whole sort of fact-finding customer holdings discussion, the value of the asset that people are living in. Now, if we assume a very conservative 25% loan to value available for a 70-year-old, then one might have, that IFA might have access, or the customers, their clients, might have access to £37.5 million worth of lifetime mortgageable borrowing. So that's further assets that they could be funding their retirements with. And that £37.5 million as a commission rate widely available in the market at 2.75% would mean that there's an extra £1 million, or just over £1 million worth of customer value or fee income value within that customer base, without having to find a single new customer. It's just realizing the potential in the customer base of the property wealth that the customers are living in. Now, of course, that not all of those customers are going to consider equity release, and some would do, if they did, would do different lending amounts and all that sort of good stuff. But the point being that if you looked at what's the potential value in a customer base, then that's a good way to look at it. If we move on to the housing market, which massively underpins the whole sort of UK PLC economy, then we have around about £12 trillion worth of property wealth in the UK, and that's privately owned property wealth. Over £5 trillion of that is unencumbered, so net of mortgage debt, and £2.6 trillion of that is held by the over 65s. So there's a massive over 65 holding of property wealth that's unencumbered, that can be tapped into to help people, do all the things that they want to do or need to do in retirement. So what I'd be thinking about, if you have customer holdings, is think about the value of the property that customer is living in and what they're doing with it. And I describe property wealth as lazy equity. It's great to live in it, but it's doing nothing for the customer. That equity, that asset is sitting there, it's growing by HPI, but it's not paying dividends, it's not generating any income, it's got a capital value, but it's not actually being put to use for the customer, for the customer's family. So average lifetime mortgage lump sum release in the market at the moment, £127,000 at a commission rate previously quoted 2.75%, would pay a commission on each release of £3,500. So if you generate into this market, if you move yourself into this market and you only did one average deal per month, then that would generate an extra £42,000 of income per year. So it's a really significant commercial opportunity from a customer base that you might already have on book and that you haven't actually done anything with yet. And what mortgage advisors are really good at is generating new business opportunities. And then they might, if they're really good, do 5 or 6 remortgages for a customer. They then help them buy their biggest asset they'll ever own. And then they wave goodbye to them as they pay down their mortgages and go searching out for the next first-time buyer to start the whole cycle again. So once, the thinking should be, once we've generated that asset, then we go back to the customer and say, right, I've helped you build that asset. Now let me help you put it to work to fund your retirement. So we'll talk about Banker Family and the power of intergenerational support. I'm just going to close my curtain a little bit, so I might go a bit dark. Apologies. So L&G's Banker Family, who used to be Bank of Mum and Dad, but we've sort of understood that Banker Family is a better characterization of the sort of sector, because we see lots of not just mum and dad lending, but aunt and uncle and granny and grandpa and even granny and granny lending into in terms of recycling property wealth down the generations. And that's where this is where that putting that lazy equity really comes to life. So if the Banker Family were a lender, then it would be the 9th largest lender in the UK. It's entirely, it's huge. So £9.2 billion worth of family lending in 24, projected to raise to over 10 billion this year. 335,000 property purchase supported by intergenerational gifting. 68% of that goes to first-time buyers, and that is a sort of bedrock of our housing economy, which in the UK we're really fixated on, but it is, it's a hugely important part of our whole sort of financial landscape. 1 in 4 family members sought financial advice before offering support, which means that 3 out of 4 families have done this stuff without taking advice, which is putting them at risk, because it's a great thing to do, but again, you need to do it under high quality advice. Now, I'll just leave on this slide for another sort of 10 seconds because there's a QR code at the bottom right of the screen, and that will take you to our guide to gifting, which we brought out, I think, at the beginning of this year. That's already had 50,000 downloads now, and what that is, it's a consumer-facing piece of work that helps you as an advisor guide a customer through gifting, how it might work for them. So it's consumer-facing, so it's really good to use for customers, but it's also really good for advisors as well. You can use it as point-of-sale material if you want to. As well. I think Daniel will be sharing the slides. You'll see there's a link at the bottom that will take you to our most recent Bank of Family report as well. Excellent. So how can equity release be used as part of a holistic retirement strategy? Well, we should be considering all of the customer's assets across these 3 sort of pillars, if you like. Firstly, to manage tax. Well, we can use property wealth to maximize available allowances. So if we think about the annual gift allowance, again, caveat, all of this might change tomorrow, but let's hope not. We can releasing equity and gifting doesn't affect means tested benefits because it's not income. If you've got a customer in drawdown, then it's really helpful to think about taking money from different assets and can help with sequencing risk. So one of the problems with drawdown is if you take money out of your pension fund when asset values are low, then you're actually crystallizing loss on low value assets. When asset values are high, that's great. That's all good. But once you take out asset from your funds, when fund values are low or unit values in old money are low, then you've baked in that potential loss. So having a property fund available to dip into and draw down on can mean that you're taking assets from the best pot within your suite of assets when you want to draw down wealth through your retirement. And enhancing inheritance. So cash released with a lifetime mortgage can create a debt that will reduce the overall value of the estate for IHT purposes because, if the debt remains at death. Gifting released cash would be IHT nil rated if the customer, the gifted donor, survives for 7 years. But the important thing is you can't just take out equity release and keep hold of the money. You've got to get rid of it to give it to get it out of the estate, and we'll come on to a good example of how that works. So what are the benefits of providing an early inheritance? Now, the average age of an inheritor at the moment is around about 61 or 2. The reality is by the time you get to that age, you've pretty much done all the hard things that you've got to do. You've put your kids through school and university. You've borne the greatest financial pressure that you'll be under in all likelihood. So actually, having an inheritance earlier than that would be actually much more useful. If you've built your career, built up your financial resilience and get an inheritance late in life, it's a nice to have, but it would have been much more useful to have it earlier. So what are the benefits of providing that early inheritance? Well, the ability to control the timing of the gift. The emotional benefit of seeing loved ones improve their lives. It avoids the need to downsize and leave the family home. So downsizing, should be considered in all of these circumstances. The reality is, if you downsize, then you don't downsize onto the same road and into the same community largely in which you live. And it can be used as part of a tax-efficient estate planning. It's also really good for referral business as well, because obviously if your customers are gifting to the next generation, then they're going to need advice on what to do with that money, and which could be investment or it could be house purchase. So either way, the value of advice is going to be really important to them. So mortgages, property, and IHT. Well, IHT supports outright lifetime gifts. There's no immediate tax charge, no tax charge after 7 years, and in some circumstances, taper relief might apply if the donor dies within 7 years. The big buts around this, though, many people don't have large sums of capital to give away. And if they do, they may well look at that and think, well, I need that for myself. I want to, that's my retirement fund. So they might be reluctant to make those gifts. Lifetime mortgages can provide capital for a lifetime gift that can be sort of ring fenced in the customer's mind. They've got their assets, their equity assets, their drawdown assets, their savings and investments, but actually the property, the mindset could be that they can ring fence that and take value from that property, reinvest it down the family and help out family members. Gifting that those lifetime mortgage funds away can increase net inheritance and deliver part of that inheritance much sooner. But the numbers need to add up for everybody involved. So I'm going to run through a bit of a case study. I'll illustrate it, and then we've got a short video. This is one of our L&G customers, Avadni. She wanted to give money to her son. She's retired, living in a mortgage-free property. She wants to help her son with a house deposit because he's still living with her, and she wants shot of him. The solution, an L&G lifetime mortgage. And the outcome, well, she's releasing money to help her son get onto the property ladder. The bigger deposit he gets is able to put down, the better mortgage rate he'll be able to buy with, and the more money he'll be able to save on a monthly basis. Reduce borrowing, better interest rate as well. So let's move on and see if we can run video.
See how I could help. Started looking at lifetime mortgages because my younger son was living with me. He's always wanted to get on the property ladder, but he's never been in a position to save up enough money for a deposit. So I started investigating to see how I could help him. I spoke to a couple of financial advisors, and the name that kept coming up all the time was Legal & General. So I thought, well, it's got to be worthwhile talking to them and seeing what they offer. I'm in the third adventure of my life. The things that I do in my third adventure is I teach drama and communication, but I also teach actors' voice work, which is something I'm passionate about. The love of my life is a little dog called Biscuit. She makes me laugh every single day of my life. She's quirky. She's a bit of a diva. She's also a bit of an actress, weirdly. They do say that we're like our dogs. I think it might be true. Well, while I was taking out the lifetime mortgage, I thought, well, I get money for James. And I thought, well, do you know what? I need a new lounge and a couple of holidays that I kind of promised to myself. And that's what I did. And I'm quite happy with that. The lifetime mortgage has ensured that my son now feels secure. That is worth more than any money, anything in the world. I'm so happy that he feels that way. And I'm very happy I was able to do that for him.
Great. So really heartwarming story from Avadni. She has the peace of mind. She gets to maintain her lifestyle. doesn't need to make any run-through payments, all the things we know about our product set. And she's accessed that cash without having to downsize and move away from her home that she clearly loves. For her son, well, security, independence, loves his mum to bits. She's always going to get a Christmas card. He'll never forget her birthday. And reduced needs for borrowing from traditional lenders, which means a better interest rate on his mortgage. So what about getting into the lifetime mortgage market then? So why and how do you do it? Well, I've talked a bit about the why. It's a great opportunity to provide high quality customer outcomes through your whole customer's life, essentially. And also it's commercially really, really viable. So let's talk about quality and qualifications and professionalism in the marketplace. Well, qualification is really, really important. The enhanced qualification that you do for lifetime mortgages helps build trust and professionalism. The Equity Release Council is our trade body, really high quality trade body that does an awful lot of work at both the, I suppose, what you might describe as the political level, but also the practitioner level as well. I sit on the standards committee, and we brought forward the revised standards over the last sort of 18 months that supported the delivery of hybrid lifetime mortgages into the marketplace, amongst other things. But the council, aside from doing all sort of tech stuff, provides a really, really good forum for advisors to network and to build those supportive sort of collaborations. So they've got a great support framework. They've recently launched their Safe Steps sort of proposition, which helps advisors navigate vulnerabilities. They also run an advisor forum, so that's a sort of and they hold regional events where you can get together. Usually they're quarterly, and meet up with like-minded people and share ideas, and just build that support framework around the industry. In terms of support available, well, there is quite a bit of support out there. So the advisor bodies like PFS and Society of Mortgage Professionals, have got access to support material. Various of the mortgage clubs put support on, and Daniel can talk to you about the AdviseWise proposition in that space and what's under development there. But also lenders do stuff as well to help advisors get into the market. At L&G, we run our Setting the Foundations workshop, and that's the bit after the exam. So the exam is relatively straightforward. And it gets you the ticket, but it doesn't help you actually deliver customer outcomes. So our Setting the Foundation workshop, it's a one-day workshop, and it's for advisors who want to get into the market, and it helps them navigate the bits around the market that are between doing the exam and making sales. So it's all the stuff around sourcing, the stuff around how the solicitor process works, what a good fact find and suitability report looks like, what advice considerations you should be thinking about. And we run those either face-to-face or remotely. Again, there's a QR code there that will take you through to our webpage if you're interested in engaging with us. We've got one scheduled for December at our offices in Solihull, and that'll be fully subscribed now, but there will be ones scheduled for next year. Okay, so in summary, later life lending unlocks new opportunities for advisors and clients. Lifetime mortgages support flexible retirement, estate and intergenerational gift planning. Banker family, a growing force in property purchases and the recycling of lazy property wealth. Professional qualifications and collaboration drive really good outcomes, and Equity Release can future-proof your advice business. So hopefully you found that useful. We'll get into Q&A. I've not had sight of any of the chat, so Daniel will be in charge of that, but please take the opportunity to to ask any questions. and between us, we'll do our best to answer. So I'll stop sharing now. We'll go back to the meeting room.
Great stuff. Thank you very much. Great presentation. Again, I've just put a reminder in the chat box. If anybody's not found it yet, if you just navigate to the bottom of your screen, you should see the logo to open it up. Given the amount of people we've got on this call, I expect one or two. Please do, provide any feedback, any insights. We have got some very experienced advisors on the call as well today. So if you want to share any best practice or thoughts or reaffirm anything that Nick's talked through, please do shout through. We have got a few pre-prepared questions. I say pre-prepared. When we sent out the invites and the mailers to sign up to this webinar, there was the opportunity to submit questions. Also, my team has been calling you all this week to obviously remind you of the session and try and capture some more questions there as well. But one, Nick, just for myself, if I can, I'd noted it down when we talked about advisors entering the market. You've talked about why the whys and a little about the hows as to how people can get into the market. What do you think is one of the most important or the single most important thing for an advisor to consider if and when moving into this sector?
I think for me, it's the responsibility. So our sector is, I suppose, risk heavy would be one way to characterize it. And I think we've all got a responsibility to demonstrate the highest standards in the sector and make sure that we're doing the best possible job we can for consumers, and we're giving them the best outcomes. So I think that it would be getting yourselves properly prepared, making sure that you know what good looks like, perhaps even finding a buddy to work alongside somebody that's already in the industry, or a trusted partner that you can work alongside. Our space is really, really collaborative. I mean, as lenders, we compete, tooth and nail, but our interest is in working together to build the market and to get more advisors engaged with the market. Our market, as we know, has gone from a high of over 6 billion down to, it'll be around about 2.5 billion this year. Following the sort of the financial upheaval that we've had since 2022, that means that a number of advisors have left the market. They've either gone away, or they've retired, or they've actually sort of turned their effort to other areas. So we can't grow the market unless we bring more advisors back to market. But those advisors, really need to engage with all of the support that's out there to make sure that they're delivering the highest possible standards.
Absolutely. One theme I've noticed from going out to events and networking, and perhaps speaking to maybe traditional mortgage advisors, IFAs, people that haven't transacted in this market specifically, a lot of the knowledge that they hold is quite out of date. Going back to when we were overseen by SHIP, same safe home income plans, and going back to some of the inflexibilities of the plans. Don't get me wrong, those products were cutting edge back then, I'm sure. But it's safe to say innovations come on leaps and bounds, even in the last 3 years, let alone the last 10 or 20 years, when it comes to releasing equity from the home. But it's unfortunate to see a lot of the knowledge out there from maybe non-specialists or people that don't look in this market is out of date. And that's the responsibility of the whole market, us doing this session with you today, but also advisors that are specialists. There's lots of friendly faces on there that I know specialize in lifetime mortgages, and it's your job as well to go out there and educate the masses and fly the flag and try and squash some of those myths as such. So from my perspective, if anyone's new on the call completely and considering entering this space, I would engage with mortgage clubs, with sourcing tools, with lenders and BDMs. I think you'll find it quite refreshing how forthcoming lenders BDMs are. No bias myself, because I was previously a lenders BDM as well, but they'll be more than happy to visit you in your offices, grab a coffee, talk through best practice, and share what perhaps some of the competitions doing, because you'll no doubt have lots of questions. But yeah, just another call. Okay, whilst we wait for that, if something does come through, it says my internet is unstable, so apologies if you're seeing that. if an advisor wants to offer later life solutions but isn't ready to do the exam, obviously it's a big commitment to put in that study time. Leaving university myself, I thought I was over with the academic, and then picking up the qualifications, it was a whole new reminder of going back to school, dare I say, some nightmares. But if an advisor's not ready to do the exam and deliver the advice themselves, what are their physical options? Because, we're not here to tell you should all advise, because you're all incredibly busy. But what are the options, Nick?
Yeah, so I think this takes us down into the world of referral and working with trusted partners, and I think this goes both ways. There will be people out there advising in this market at the moment who are quite sort of, I suppose, linear in terms of their thinking and their proposition. They will, and my challenge to them would be, we've got to think broader than that. You've got to find referral partners for customers that have got wealth needs, or that tax planning need. So that's looking from our market into the IFA market, and developing those trusted relationships. At L&G, we run a session. Our BDMs have got sort of they've got, I suppose, content on helping build professional connections, and how you go about sort of building those professional networks. If you're sort of the other end, you're not engaged with the market, and you're thinking, well, I've got customers who need this stuff, but I don't necessarily want to do it for myself for whatever reason. Then finding those referral partners is not, there are a lot of people in our marketplace who are really actively looking for those introductions, whether that be via whichever mortgage club you use, or your broader advisor network. Then it won't be difficult to find somebody who wants to support with you in this space and work with you in this space. But also, it's a really good way of getting into the market in terms of riding shotgun with an experienced advisor, and seeing how they deliver the advice, and how they sort of go about their business, can actually help your progress into the marketplace. If you don't want to do it now, but you might want to do it in the future, then why not view that as an option? Excuse me.
Great stuff. And Vanessa, thank you for your comment in the chat box as well, and the offer to have meetings or teams with people that are relatively new and want to ask questions from experienced advisors. And just a shout out to the council as well. They've got a great expert team there that can provide a load of resources to get you going and point you in the right direction of this area of advice. Nick, I've noticed there's quite a few maybe notable and large mortgage practices, for example, that have identified the opportunity. They've seen that they've got an aging client bank and they perhaps can't service them effectively. They've perhaps got customers that are failing income and affordability because we carry so much debt now. It seems quite socially acceptable to carry that debt into retirement. Have you got any case studies or examples of mortgage practices or any financial houses that have embraced this area of advice and taken it quite successfully?
Yeah, I mean, there's I won't name names, because that I haven't spoken to those businesses and got their permission, but I will sort of give a couple of examples. And so one smaller mortgage practice that it's 2 or 3 advisors, and they were mortgage only, but could see that there was a real sort of opportunity in this space. They engaged with us and put their 3 advisors through a qualification workshop that we used to run, that we're looking to actually resupply next year. And so they put we supported them through their exams. They then sort of started to market to their customer base, and we held their hands through that process in terms of providing them with some B2C marketing support, and then found them or referred them on to trusted solicitor solutions, and mortgage club solutions as well. So that was a real, and they've not set the world alight, but they're now in the market and they're regularly writing business, which is great. Another example, one of the major mortgage networks, really significant, were not in our space, had a referral solution with a master broker in our sector, but wanted to deliver advice under their own steam and keep control of those customer outcomes. And we pitched to them pre-COVID a single tie solution with L&G, and we got a long way down that track. So they would, we would support them, do all the training, do all of that sort of stuff, and they would only recommend L&G lifetime mortgages. That actually didn't get off the floor. They decided to launch the market under the support of a network with a restricted panel, and so that gave them the support that they wanted to do. So that's one of the things that's quite interesting in our market, is the ability to go under dual authorization. So you might operate under a network over here that doesn't want to do lifetime mortgages, but you might do your lifetime mortgage permissions through a different network, or you might be DA in this space, but operate as an appointed rep under a network in the lifetime mortgage space, and we've seen examples of that as well. So this major mortgage network is now sort of 5 years down the track, has got, I think, about 40 advisors now who's specialising in this area, are now operating under their own steam. They've moved away from their network and become directly authorised. And yeah, that is and are now a really significant player in the market. So I suppose two ends of the spectrum and two sort of different examples, but both really good examples of where firms have engaged with the market and built business on the back of it.
Amazing, thank you. Really appreciate that. A couple from Dave Griffiths, and David, thank you. You submitted 2 questions throughout the sign up journey to this, perhaps a little bit more product related or a little bit more lower level than the session at hand, but I think we can quite easily box those ones off. But David just had a question in and around varying proc fees for drawdown plans as opposed to lump sum, and the secondary question was the conveyancers, the solicitors that L&G use for the transaction that is equity release.
Okay, yeah, so our solicitors were Connexo, but they exited the market I think last year. So Enact our preferred conveyancer now. We were quite pleased with that, actually. We Enact is a new relationship for us, and that's going pretty well, very well, I think. But also they told us last week that our offer to completion time lapse is the fastest in the market at the moment. So props to L&G operations guys. That's fantastic. On the proc fee thing, then, yeah, I mean, each company has their own procuration fee policy. So for us, we pay a consistent procuration fee for either lump sum or drawdown initial releases, and then we pay a lower amount of procuration fee for individual drawdowns. But we still pay for the drawdown. So I know some firms do pay an upfront fee based on the potential in a drawdown, in a drawdown fund. But we've always been, on the other end of that sort of thought process. Yeah, we pay for the initial, we pay a reduced rate for the drawdown.
Amazing. Thank you, Nick. Well, I'm not seeing any more questions in the chat box, so we've probably got time for one more if any quickly comes in. But if we don't in the next few seconds, I'll roll through to closing. But we have just had one. Neil, well timed. You were probably frantically typing that one out. So let me just. Do you think the current higher interest rates are a barrier to entering the market, or in my case, generating or recommending a lifetime mortgage as a solution?
Well, I suppose. Yes, possibly. I think it's all about context. I mean, the rates that we enjoyed from sort of, I suppose, 2015 when we came to market, we were the first lender to go under 3% for a lifetime mortgage rate. We then had rates, regularly that started with a 5. At the moment, they start primarily with a sort of 6 or a 7, and there are, we've seen some very, very high rates for very high loan to value lending. So, our market is not necessarily a market now for buying speedboats and conservatories. That sort of very discretionary sort of spending. It's much more of a market for well considered borrowing that's done under really high quality advice. And we can see. I see the sourcing numbers that come in from the different sourcing engines. Sourcing inquiries are going up sort of month on month. Not much, but they are going up month on month, and that's really encouraging. That does sort of indicate that there's a bit more confidence coming back to market, and there's a bit of latent buyer demand coming to market as well, because I think customers have got to the point now. And advisors should have been at the point miles ago, ages ago, to say, well, this is the price now. I was on a asset management call just before this one. L&G are expecting 2.5 rate cuts next year, Bank of England based rate cuts next year. That won't really affect us. Our market is driven by the long-term cost of borrowing, and so there's no sight of government borrowing costs coming down in the sort of medium term. So I think our price is where our price is. So we need to be able to adapt to what the market, how the market's currently priced, and have the confidence to have that conversation with customers that actually it's still fair value in the marketplace.
Super. Thank you. And thank you, Neil, for the question there as well. We have got a couple of minutes left. I'm just going to look through the closing notes here as well. But Nick, just wanted to extend a thank you. Thank you so much. Super insightful. I think everyone will agree that we have picked some practical ideas and perhaps some case studies and some areas that we can, take action on after this session. I really like the case study, highlighting the areas around IFA practices with the, perhaps the blinkered view of funds under management, and not so much looking at the property values under management and the opportunities that land there. It's safe to say we're an aging population. We're asset rich, cash poor, and we must assess all asset classes when looking at funding retirement. I will do a shout out for the Fairer Finance report. They released something earlier this year. I've mentioned it before and I'll mention it again. It's a really smart booklet that I believe they co-branded with the council that goes through how property wealth can be leveraged in later life, and they bring in government policy and some of the challenges and different perspectives. And it probably only takes 20 minutes to run through. And I would encourage you all to go on the council's website and type in the Fairer Finance report, and have a little nosy. Massive recommendation for that one. Just in closing then, for everybody watching, you'll receive the recording and follow up with the CPD certificate link via an email very soon. If it's not by the end of today, it will certainly be by the end of tomorrow. So if you want to watch it back, if you've missed anything, if you had to nip away or want to share it with any colleagues, the recording will be available on demand very soon. We often get a lot more engagement from the on-demand watching than we do the live sessions. It's great to see such bumper numbers, and I expect to see that grow over the next few weeks. We will, of course, share that across social medias as well. If you're not yet using AdviseWise, just a shout out for us to source and compare products, and you'd like a refresher, you'd like to look at the tools, how to get in touch, please do reach out. You can find me on LinkedIn, and you can find my contact details. I'll be doing the follow-up with you over email very, very soon. Thank you again for joining us, and you're all free to leave. We're pretty much bob on for time, 11:59. So thank you, and thank you, Nick. I'll just hang on until the end of the session. And
thanks everyone. And if you're mad enough to want to watch it back, then please be gentle with me. So thanks very much.
It is all free to leave. Thank you.